On Tuesday, the spot gold market was hammered by multiple bearish factors, with prices closing down $19.6 at $4,715.25. Although geopolitical tensions initially provided safe haven support, gold plunged more than 1% intraday under the dual pressure of robust inflation data and surging oil prices, which drove U.S. Treasury yields higher. The U.S. April CPI data proved to be the market's turning point. The figures showed CPI rising 3.8% year-on-year, exceeding the expected 3.7% and marking the largest annual increase in nearly 3 years. This hotter-than-expected inflation forced investors to completely rule out the possibility of rate cuts in 2026, with some even pricing in an over 30% chance of a Fed rate hike by year-end. Consequently, the U.S. dollar index climbed to 98.30 and the 10-year Treasury yield surged to 4.457%, triggering a sell-off in non-yielding gold. Furthermore, the situation between the U.S. and Iran deteriorated rapidly. President Trump described the negotiations as completely unacceptable, while Defense Secretary Hegseth issued a stern warning, stating the U.S. military has contingency plans ready for escalating military action against Iran. This rhetoric pushed WTI crude oil up over 4%, breaking the $100 mark. The spike in oil prices not only intensified stagflation risks, forcing central banks to remain hawkish, but also bolstered the dollar, dealing a secondary blow to gold prices. Currently, gold has breached several key support levels, and market focus has shifted towards hedging against runaway inflation and interest rate risks. While the fragile nominal ceasefire between the U.S. and Iran may offer occasional safe haven support, gold is expected to remain in a weak consolidation phase in the near term as it faces the dual hegemony of a strong dollar and high bond yields. All content is for informational purposes only and does not constitute investment advice. Trading involves risk. Proceed at your own discretion. Please subscribe, like, and share. Thanks for watching.